Hey everyone, welcome back. Today we're diving deep, really deep into the world of quant investing.
Quant. It's a word that gets thrown around a lot these days, but what does it actually mean for investors, especially for professionals like you listening in?
Well, that's exactly what we're here to unpack. And to guide us through this complex landscape, we have, a real expert.
I don't know about all that.
Oh, come on, you definitely are. You've been deep in the quant world for quite a while now. But let's start by introducing the man himself.
We're talking about Jonathan Briggs, PhD, and his story. It's not your typical Wall Street journey.
Yeah, you don't often hear about someone going from, control theory to finance.
Right, control theory. It's all like designing systems that behave in very specific ways, like think about self-driving cars or rockets landing themselves. Pretty complex stuff.
So how does one go from, programming rockets to playing the stock market?
Well, it seems his path took a turn when he landed in San Francisco during the dot-com boom.
The dot-com boom. That was a wild time.
Oh, absolutely. And he got involved in the very early days of robo-advising at Charles Schwab, kind of the precursor to all the automated investing platforms we see today.
Yeah, Schwab, they were definitely ahead of the curve on that.
For sure. And that experience seems to have really ignited his passion for finance. From there, it was on to Barclays Global Investors, a real pioneer, a true giant in the quant world.
BGI, that's a name everyone in finance knows.
Exactly. And he spent several years there developing and refining those quantitative equity models, working alongside some of the best in the field.
So he was really honing his skills at BGI. But then he moved on to, CPPIB, the Canadian Pension Plan Investment Board.
That's right, CPPIB, a massive fund with, a very long-term perspective when it comes to investing.
Makes sense for a pension fund, right? Thinking decades ahead.
Absolutely. And managing those huge sums of money, it exposed him to a whole different side of the investment world.
Okay, so we've got this control theory expert turned seasoned quant investor. But what makes his approach unique? What sets him apart?
Well, this is where it gets really interesting. Jonathan, he really dug deep, went down a rabbit hole studying legendary investors, folks like Warren Buffett.
Oh, wow, Warren Buffett, the Oracle of Omaha himself.
The one and only, but also George Soros, Carl Icahn, all these big names with vastly different styles.
So what did he find? Some common thread linking these investing titans.
He found that despite their wildly different approaches, they all shared one crucial element: a heavy reliance on fundamental analysis.
Fundamental analysis. So really understanding the businesses they're investing in, not just looking at charts and numbers.
Precisely. Digging into those financial statements, understanding the core operations, the management, the competitive landscape, all of that.
Makes sense. You need to know what you're buying, right?
Exactly. And he realized that traditional quant strategies, the ones often prioritizing breadth over depth, they were missing this.
They were missing the fundamentals, the why behind the numbers.
Precisely. And that's what led him to develop a new approach, one that incorporates both the quantitative rigor and that deep understanding of fundamentals.
Okay, this is getting me intrigued. And this new approach, it's the foundation of his firm, Delphia.
Delphia, that's right.
Before we get into all the specifics of Delphia's strategy, maybe a quick refresher on some of those quant basics for our listeners.
Sure, happy to.
Terms like value, quality, momentum get tossed around a lot, but I think it'd be helpful to just level set.
Yeah.
Especially for our professional audience who live and breathe this stuff.
Absolutely. And those are what we call factors in quant investing. Essentially, they're characteristics of companies that can be used to try and predict future returns. Think of them as signals, often hidden within all that financial data.
Okay, I like that. Signals hidden in the data.
So let's take value investing, for example. This is all about finding those companies with strong fundamentals, good, solid businesses.
Right, companies that are doing well.
But here's the key. Their stock price is low relative to those strong fundamentals. Almost like getting a great deal, finding those undervalued gems.
That's the dream, right? Finding those hidden gems.
It is. Now then you have quality, which looks at a company's, how profitable they are, how healthy their financials are.
So are they consistently making money? Do they have a solid balance sheet? Things like that.
Exactly. And finally, there's momentum. This one's a bit different. It's based on the idea that, past stock performance can be an indicator of future performance.
So if a stock has been steadily climbing, momentum investors believe it's likely to keep going up.
Precisely. They're kind of riding that wave. Now, quant strategies, they typically try to exploit these factors, these signals, in a systematic way. But, and this is important, this approach has run into some hurdles recently.
Hurdles? Like what?
Well, the rise of smart beta, you've probably heard that term. It's essentially packaging these quant strategies into easy-to-access investment products, ETFs, and things like that.
Yeah, smart beta is everywhere these days.
And that popularity, it led to a lot of, well, commoditization. Returns became less impressive as more and more investors piled in.
Ah, so the secret sauce got diluted.
Exactly. And this led to what some call a quant winter, a period where investors became disillusioned with those traditional quant methods.
The quant winter. So how did Jonathan respond to this shift in the landscape? This kind of chill in the air for quant strategies.
He saw it as an opportunity.
An opportunity.
Yeah. He recognized that those traditional approaches, with their emphasis on breadth over depth, were missing something.
That deep understanding of the businesses themselves.
Exactly. And this is what ultimately led him to develop that new approach we talked about, the one at the heart of Delphia.
All right, I am definitely ready to dive into Delphia, but maybe we'll save that for the next part.
Sounds good to me. All right, so let's pick up where we left off, digging deeper into Delphia and Jonathan's unique approach to quant investing.
Yeah, I'm really curious about this, especially those two terms they emphasize, surprise and fundamentals.
Right. It sounds a bit counterintuitive almost when you think about traditional quant strategies, but it makes a lot of sense when you hear them explain it.
Okay, so let's try and unpack that. What exactly do they mean by surprise in the context of investing?
Well, they believe that those big market-moving returns, those times when stock prices really jump or plummet, they're ultimately driven by surprises.
Surprises.
Yeah, specifically surprises related to a company's financial performance. Think about it. The market's always forming expectations, right? Analysts making predictions, investors placing their bets based on those expectations.
Right. Everyone's trying to guess what's going to happen next.
Exactly. And when a company's actual results, their earnings, for example, come in way different than those expectations, that's when you see those big price swings.
So they're essentially trying to predict these surprises.
That's the big idea, and this is where the AI and machine learning come in. But Delphi's approach, it's got a key difference.
What's that?
Instead of just feeding algorithms tons of raw market data, like stock prices or trading volume, they focus on forecasting those cash flow-related fundamentals.
Cash flow fundamentals, so like the actual money coming in and out of the business. The core stuff that drives a company's value.
Precisely. Think of it like this. They're giving the AI the right ingredients, the core elements that really matter in the long run, not just surface-level stuff.
So they're not just looking at market data, they're going deeper, trying to get at the underlying financial health of the company.
That's it. And here's another twist. They realize that the insights, those KPIs that experienced fundamental investors use, the things they look for when analyzing a business, they were incredibly valuable in this whole process.
So they're not throwing out human expertise altogether.
Nope, they're embracing it. They actually incorporated those human-derived insights into their models.
And did that improve things?
It did. Their forecasting accuracy got a major boost.
So they're combining cutting-edge technology with the wisdom of experienced investors, a blend of, human intuition and machine precision.
It's a powerful combo, and it's especially interesting given how Delphia accounts for those different investor cohorts we were talking about earlier.
Value investors, the momentum chasers, the short-term traders,
Right.
all reacting to the same information, but in very different ways.
Exactly. They recognize that the market isn't one big monolithic thing. It's a bunch of different players with their own expectations and time horizons. And how each group reacts, well, that leads to distinct patterns in how stock prices move.
They have a name for those patterns, right? Return signatures.
That's the one.
Okay, give me a concrete example of how these return signatures play out.
Okay, imagine a company, let's say it's about to release its quarterly earnings. Now, there's one group, maybe they're feeling bullish, thinking the company's going to beat expectations. That's the consensus view. Then there's another group, a bit more skeptical, thinking the company's going to fall short.
Got it, the contrarians.
Right. Now let's say the company actually does beat those expectations. The stock price is probably going to go up, right? Makes sense. But the pattern of that price movement, well, that depends on which group is really driving the market at that moment.
So the return signature tells you who's in control, who's calling the shots, the bulls or the bears.
Precisely. If that consensus view is really strong, A lot of investors are already expecting good news. You might see a gradual upward trend leading up to the earnings announcement, then that final bump when the actual numbers come
A
out.
classic momentum play, buy the rumor, sell the news kind of thing.
Exactly. Now let's flip it. Say the contrarian view was right, and the company actually missed those earnings estimates. Stock price would likely drop, but the pattern would look different. You might see a period of underperformance leading up to the announcement, then boom, a sharp drop when the bad news hits.
So that's more characteristic of a value signature.
You got it.
So I'm guessing Delphia's models are designed to try and identify these different signatures and then predict how those cohorts will react to upcoming surprises.
That's the key. They use those insights to kind of arbitrage between the different groups, essentially betting on which cohort is most likely to be correct in their assessment.
Sounds incredibly complex.
Yeah.
I mean, how do they keep track of all those moving parts, like a giant chess game, with all these players making different moves?
It is complex, but that's where the power of machine learning comes in. Their models are constantly learning, adapting to new information as it comes in. And, this is another area where things get really interesting. Remember we were talking about the rise of retail investors, those folks on platforms like Robinhood?
Yeah, the meme stock frenzy, GameStop, all that.
Exactly. That's added a whole new layer of complexity to the market. It's like throwing a wild card into the mix.
And I'm guessing Delphia is not ignoring that.
Oh, absolutely not. They're actively trying to incorporate those retail flows into their models, trying to understand the motivations, the behaviors of this new breed of investor, and how their actions might impact, well, everything.
So it's not just about fundamentals and quantitative analysis anymore. There's this whole behavioral element they're factoring in.
Precisely.
Okay, enough theory. Let's talk performance. How's this whole approach actually working for Delphia?
Well, there are some legal limits on what I can say publicly about specific returns,
Sure, of course.
but I can say the results are exceeding expectations.
That's good to hear. But I imagine they're aware of the risks involved, too. No strategy is foolproof. Right?
Oh, absolutely. They're very conscious of that. They even use this analogy of a venomous spider lurking unseen to describe those unknown unknowns that could impact any strategy. It's a good reminder that even with the most sophisticated models, there's always an element of uncertainty in the market.
I like that. A venomous spider. A good dose of humility, especially in this business.
Exactly. But their rigorous testing, their risk management processes, those have been working well so far.
Now, all of this sounds very sophisticated. Is this the kind of thing only available to big institutions with vast resources? Or can regular investors participate?
That's a great question. And what's really interesting is that Delphia actually offers strategies for both institutional and retail investors.
So they're not just catering to the hedge funds and pension funds of the world.
Nope. They've got options for everyone. Although, of course, there are some differences in how those strategies are structured.
Makes sense. Different investors, different needs.
Right. For their institutional clients, it's typically pure long-short portfolios. But for retail investors, they've got offerings that are more accessible, maybe lower risk, and they take into account those regulatory constraints that are more applicable to individual accounts.
So they're tailoring their approach to fit the specific investor.
Exactly. They're committed to providing investors of all sizes with the tools and strategies to, navigate these complexities of the market.
That's great to hear. All right, I think we've covered a lot of ground here. Maybe it's time to move on to our last part and wrap things up. What do you think?
Sounds like a plan.
Okay, so we've gone deep into the weeds here with Delphi, but let's zoom out a bit for our listeners and recap what we've learned. Any big takeaways that stand out to you?
I think the biggest one for me, the one that really stuck, is that quant investing, it's evolving. It's not just about crunching numbers and finding those little statistical edges anymore.
Right, there's a lot more to it now.
Exactly. And I think Jonathan's work with Delphia, it really highlights how powerful it can be when you combine that quantitative rigor, all those algorithms and data analysis with a deep understanding of the actual businesses.
Yeah, the fundamentals. We keep coming back to that.
For good reason. It's essential. You have to understand those cash flows, the growth drivers, all those things that really drive a company's value over the long term.
And if you're trying to stay ahead of the curve, well, understanding those return signatures, those distinct patterns created by those different investor groups, that's a game changer.
Absolutely. Recognizing that the market isn't this one monolithic entity, but rather a collection of different players, each reacting to information in their own way. I mean, that's crucial for anticipating how prices are going to move.
It's like a whole new layer of analysis, a deeper level of understanding.
Right. And Delphia, They're at the forefront of this, pushing the boundaries of what's possible with quant investing.
It's been fascinating to learn about. So for anyone listening who wants to learn more about Jonathan, about Delphia, where should they go?
Definitely check out their website. They've got tons of great information on their approach, their research, their whole vision for the future of investing.
And they have those options for both institutional and individual investors, right?
That's right. So no matter what type of investor you are, there's something there to explore.
Awesome. Well, we've covered a lot of ground today, haven't we? From control theory to cash flow predictions, from market cohorts to, what were those called?
Return signatures.
Yes, return signatures. It's been a fascinating deep dive into the world of quant investing, and it leaves us with a really interesting question. In a market that's constantly changing, becoming more complex, can you as an investor really use these advanced tools and insights to gain a lasting edge? Or will the market always find a way to adapt, to outsmart even the most sophisticated strategies?
That's the million-dollar question, isn't it?
It is, and it's one we all have to grapple with as we navigate the world of investing. But hopefully, this deep dive has given you some food for thought, some new perspectives to consider.
Definitely.
So thanks to everyone for joining us on this exploration of Jonathan Briggs's work and Delphia's innovative approach. We hope you enjoyed it. And until next time, happy investing.